Hey everybody, my name is Kyle Knott and I am not your average finance guy. Got a little IBC example for you behind me today, and some people really push infinite banking, because IBC is an infinite banking concept. They push this as an investment. And what I'll show you first is what is possible as an investment. It makes money, it's guaranteed money, and it's good, but I think it can be better. And I'm going to show you how it can be better and how I use it to be better. So here's an illustration we've got, and what this is it's starting off the first year we had a lump sum that we could put in of 30,000 to kind of get this thing supercharged and get the cash value built up as quick as possible. Every other year after that, we're putting in 20, we're putting in 20,000 every year until we get down to 10 years. So this is a 10 pay example, and this is how we've got this going on. So what we've got here, this is what we've put into it, and over here is the cash value available. Now, I've said this a couple times that this really doesn't start off, it's not real efficient the first couple years. It takes a little bit to get this thing going, to get this off the runway, if you will. So you see here, 30 went in, 26.6 of cash value. It's like, what kind of investment is this? And actually, I can get less out than what I put in. Like, what the hell? But stick with me. 20 in, so now we're up to 50. We're getting closer. Now we're at 70. We're almost there. Year 4, we've got 90 in. We are just about, we're right there. Year 5 is when it pops. So 90, we've got 110 in. So after this, we're in and we're golden. So year 5 and continuing to do this. I didn't do every year all the way down, but year 10, everything added up, the 30 the first year with 20 every other year, down to 10 is $210,000. This is the 10 pay. That's all this person would put in, is $210,000. This is my policy. Okay. When I first built it, all I will put in, or all I have the option. I can keep going after this. I'm going to, trust me, but $210,000 in over 10 years, and in 10 years, 210 in, it'd be worth almost 250. So there's a $40,000 gain. That's not bad. I'll take it, right? So after 20 years, again, this is all I theoretically could put in. I'm going to put more in. I'll jack those numbers way up. But however, we're just going to go back to this example. After 20 years, you're 422. 30 years, you're 707. 35 years into it, after putting 210,000 in, you are at just shy of a million. Basically, you're 100,000 short of a million. So with doing that in and of itself is not guaranteed. Those aren't guaranteed numbers. Those are guaranteed numbers plus dividends, that the dividends have paid every year since like 175 years ago. So those numbers will be very, very, very close to what the cash value will be through all these years. So if you're doing that, you could look at it, and this, to me, it's way safer. If you want your money in a safe harbor, if you think the savings account is the way to go, then I would do this. This is way safer than a savings. If that's all you're doing is just plowing money into a savings account, putting it away for a rainy day, this is the way better way to go. But where this works is all of these numbers, they stay the same no matter if we take out a loan against this or not. So what I do is, let me put my mic here, see if that still works, is I started with this little example, and what I said here is in year 3, if we take out a $30,000 loan and buy an asset, this is my stupid little house drawing there. So if you buy a rental property in year 3 and you take out, this is what's available to you. And if you can do this and take out $30,000 loan, and let's say during that year you can pay back $10,000. So at the end of the year, this is my little balance sheet over here, we still owe 20 grand on the loan. Let's say in year 4, now we've got 89,000 available minus the 20, so we've got essentially 69 available. Let's take out another $40,000 loan. Let's say at this point we can pay back 20 throughout that year. So now we still owe 20,000. And the 5th year we have access to $112,000 minus 40. Let's say we take out a $60,000 loan. All right. And then at the end of that year, we can pay back 30. And then one more year later, it's out and we don't know more on it. So by the time we get to year, and at that point, we're done. We bought 3 rental properties in the first 5 years by all we did was we put our money over here in the premium side of it first, and we borrowed against our cash value. Okay. So I could have used that money and just bought the house. Okay. We could have just bought the houses using this money in a savings account. But here's the magic. Remember those numbers I showed you at first? Those don't change. This is the magic part of the infinite banking concept, is those numbers continue to continuously compound, uninterrupted compounding for life until you die. This is a life insurance product, and this is a guaranteed whole life product. Only put in 10 years worth of premiums. Why not get to here? You could have bought the 3 houses. And what I did is I ran this out to 35 years, because in the first 5 years, let's say we bought these houses and let's say we put a 30-year fixed mortgage on it. So after 30 more years gets you to 35. In 35 years later, you still have $904,000 available to you. You can use it as retirement income. You can buy a boat, an RV, go do whatever you want to do, trip around the world. You have access to that money. So, and yes, you have to pay it back, but it just comes out of your death benefit. Your death benefit will be millions of dollars by that point. Let's check. What is the death benefit at the 35th year? Would be 1.33 million, 1.34 million. So not that big a deal. If you want to take it out, it's early access to your death benefit, and then you die right after it. Your heirs get the rest of it. So that's what that part is. Now, but in 35 years, you've got 3 rental properties that are bought and paid for. You don't owe any more mortgage on them unless you wanted to do some other stuff and take out a home equity line of credit or stuff like that. But you got options. So at that point, you've got 3 rental properties free and clear. You're still renting them out. I would hire property managers and let them deal with all the headaches. All they do is send you a check every month. And sure, it's not as efficient as if you're doing it yourself. It's going to cost you some, but I think you get what you pay for. So worst case scenario, 35 years down the road, you've got just shy of $1 million of cash value. You've got 3 more houses. If you just owned your own house, now you've got 3 more. These are all making rent income. So whatever the rent is, most of that, you don't have to pay the mortgage anymore. That's paid off. You still got to pay your taxes, insurance, and maintenance and things like that. So it's not 100% into your pocket, but you got 3 more sources of income that are still appreciating in value. What are those going to be worth in 35 years? I didn't say what we bought them for, and I'm not even going to speculate because it's all kind of made up imaginary. This is just an example. But wherever you bought them at, for if this was your down payments, $30,000, $40,000, and $60,000, I see we're bumping that up every year. We're putting our money to work, and it's not even we're borrowing against our cash value. Our money stays in there and it keeps working. We're using the insurance company's money, and yes, we got to pay it back. I put that in there. Okay, the loans right now to pay back are 5.68%. Show me any mortgage that you can buy that you can find for 5.68%. You can't do it right now. So and now this is just your down payment. I'm still getting a mortgage on these. So those numbers are just down payment, but it doesn't matter as long as the cash flow is there and you can make those payments back. And guess what? You can set whatever payment you want. If you want to pay $1 a year for the rest of your life, you can. It's just you're not going to be able to pay that stuff back, and you might not be able to take as big of loans as when you want. So that'll affect your cash value. Always stays the same, but it's how much do you owe. The faster you pay that back is the more that you'll have access to. Basically, it's your cash value minus what you owe is what you could then take as collateral, or that's your collateral, so you can take that as a loan. So again, back to at the end of this, 35 years down the road, obviously the earlier you start this, the better it is. At this point, I'll be 75 years old, and I've got more than that already, but this is one example of how you can have almost $1 million to live off of if you need and want to, and you've got 3 more rental properties free and clear. So what are rents going to be in 35 years? Who knows? probably be a couple grand, if not, who knows, 10 grand. You might have 30 grand coming in every month over there just with those. What are they going to be worth? What if you need to sell one and pay for your granddaughter's wedding or whatever you want to do? If you want to, you can do a cash out refinance. You can actually put a mortgage back onto one of them, have the other two pay it off, and you just get a whole pile of cash. Still tax-free, because these are all loans. Loans are not taxable events. This money is safe from creditors. If you get sued somehow in some of this over there, that's not tied together. Hopefully you've got this in an LLC or some kind of protected entity, and they can't get at this money. So there's just so many different ways that you can do this. And this is just one super easy example where we just put 3 rental properties. Maybe it's 3 other assets. What are you into? Maybe you buy and sell businesses. I don't know, car, whatever it is. This is what I like. I'm into real estate. It pays cash, gives you cash flow every month. It appreciates in value. You got tax advantages over here. This whole thing is already tax advantaged, but it's just one way to look at it. And who's to say once you get into 3 of them, are you really going to stop in 5 years? I mean, hell, keep going. What if you could do 3 more in the next 5 years, or if you could do 1 more every year for the next 5 years? At that point, maybe you got 8, 10. And now you don't have to worry about what your 401k or what the markets do, because you got paid off houses. Or maybe you've got, look, they're 3, 4, and 5th year. So after year 32, they're going to start, one's going to be paid off. Now the next one's going to be paid off. Maybe, and heck, who knows, maybe you borrow against that and you just pay them off. So you got more cash flow coming in. The opportunities, the choices are endless. Your options are endless. So, this is the big part that was hard for me to understand, was that the cash value, those numbers are numbers. Those don't change no matter what you borrow against them as loans, because you don't pull the money out. You don't take your money out. It's not a savings account. Savings account only earns interest when the money's in there, right? Once you take that money out, you no longer earn interest on money that's not there. This is the different part with the infinite banking concept. The money never leaves. It's always earning, uninterrupted compounding. And that's where the miracle of it is. So like I said, what I started with, if you start off with a $210,000 input of money, and in 35 years, you got 904, would I do it? I could probably find a better place for $210,000, honestly. But when we can do this and this, then yes, there's nothing better in my opinion. I could have taken the 210 and put it straight into the houses there, and same boat. Maybe in 35 years, I've got 3 free and clear houses that are, my rent's coming in. That's still a good option to do, but why not have another $1 million sitting on the side? Hell, that could be your emergency fund, whatever you want. At that point, I'll be 75 years old, and hopefully I'm not quite knocking on death's door, but and if I don't die, guess what? Every year, this continues to go up. I just stopped it at 35 years. If I go to 45 years, it is cash value 1.4 million. 50 years, 1.7 million. 55 years, 2 million. So I don't know if I'm going to live that long or not, but it keeps growing exponentially. This whole thing keeps compounding on itself. So that's the beauty of the infinite banking concept. I hope this helps. Good luck.